I want to see how you see today shaping up. What's your WEX word of the day?
Well, my WEX word of the day is the Fed, because I think that this whole week is going to be dominated by central bank news, predominantly the Fed's messaging that we get later this week.
All right, so you say it's all about the messaging. So if it's about the messaging, does 25 to 50, does that matter, or is it really what Jay Powell says later?
For me, I think the 25 or 50, I think you could make a perfectly neat case for either one. The 50 could kind of be like a catch-up case. But the messaging, the summary of economic projections and the press conference, I think will matter a lot more.
I want to get your take on what hedge fund billionaire John Paulson said to our colleague Sarah Eisen last week about the Fed and also the speed of these rate cuts. Take a listen.
Personally, I think the Fed is a little behind the curve. Rates are, 5.25 plus, and inflation's down to the 2.5% rate. So we have almost 3% real interest. So I think they've seen enough data that they can start bringing rates down. And I would suggest more aggressively would be better. So I'd be for a 50 basis point cut rather than 25.
So, Mimi, you kind of say it doesn't really matter. He's saying that we kind of need to see those 50 basis point cut. In your mind, is there an argument that the markets, the economy, they need that 50 basis point cut?
I mean, there certainly is. It's 50-50 priced in right now, right?
Right.
What I was trying to say is I think you could make a case for either. He does point to a fairly aggressive path right now. We have 10 cuts priced in between now and the end of 2025, for instance. And I think that's justified as a midpoint, given where the economy is right now. And we are far above what the Fed or what we would perceive as neutral.
All right, so far above neutral. Also want to talk to you just very quickly about the valuation of the market. Right now, the S&P trading at about 21 times. FactSet put out some data. 10-year average is about 18 times. What does that mean as you look to make moves in this market, the fact that we're trading at that type of a valuation?
Yeah, so we've been underweight equities, overweight fixed income, because we thought that portfolio would perform better in a range of scenarios, right? If we do slide into a shallow recession or anything like that. Having said that, within the equity exposure, we are looking for, to see things broaden out a little bit, like your last guest was saying. And we do like defensive sectors like consumer staples and healthcare.
You mentioned your overweight bonds. I'm kind of looking at your pick for us today as bonds, and we're going to show the bond board right now. I'm looking at the 1-year yield above 4%. Then you look at the 30-year yield almost at 4%. Do you play the short end? Do you play the long end? I mean, do you want to lock in that almost 4% yield? Is that worthwhile? Even the 20-year above 4% as well?
The projections are terrible for the deficit, so it's hard to say. It's hard to get excited about the very long end. The position in bonds is something that we've held on to. We think that there's nothing unreasonable about them right now. But if I were to take a new long, it would probably be in the belly.
Actually, it'd be in the belly. I have to ask you, and I'm surprised more people aren't talking about the short end, the 1 year. I mean, 4%. We're expecting some volatility in the markets in coming months, and then after 1 year, you have your cash back available. Why isn't that a big pick or a 6-month or shorter N1s?
Yeah, look, we have cash in the portfolios too, and I think it's fine to ride the front end, but that's not a very long-term play, certainly. Right now, we are entering, as you said, an easing cycle. It's not going to be a one and done. This is a cycle that we're coming up upon.